All right, welcome everyone. My name is Mei Chen from the University of Arizona. I'm excited to moderate today's workshop. We have Andrew Jackson from University UNSW Sydney, okay? And Andrew's research from his webpage seems to be related to how market participants utilizes accounting information, including financial analysts, including decomposing profitability, as well as earnings co-movement and earnings manipulation. Today, Andrew will talk about asymmetric timeliness in earnings. And I also want to thank organizers Ayan and Stephen for creating this opportunity to get us all connected. Despite COVID-19, all these negative sides, one of the few positive sides is that it encourages us to embrace technology more so that we can get connected more closely with researchers across the globe, including Andrew. Before we get started, again, a few ground rules. Number one, please mute yourself unless I call your names. And if possible, I strongly encourage you to turn on the camera. So this is better mimicking workshop environment. If you have a question, please type question in the chat box. I will find a good time to interrupt Andrew and call your names in the order. Okay, so once your name is called, please unmute yourself, introduce your name, your school, and then ask your questions. If you do not necessarily have a question, but you want to share with Andrew your comments, please type your comments in the chat box and just put in parentheses, no question, so that I can move the question to the next person. Let's give Andrew the first and last 5 minutes uninterrupted. Again, I'm excited to look to Andrew's presentation and all your comments. Andrew, please take away.
All right, thank you, Mei. And again, thank you to Ayung and Steve for arranging this. Being in Australia, usually we've got the tyranny of distance, which precludes us from being able to share our research, especially in the US quite often. With COVID, it's usually the tyranny of time zones, but thanks to Ayung, we've actually eliminated all of that, so there's no tyranny here at all. So the paper that I'm presenting today with two colleagues at UTS, Yoan Shan and Steve Taylor, we're looking at revisiting the asymmetric timeliness of earnings. So taking Sudipta's paper and trying to move forward and understand a little bit more about why do we have this asymmetric timeliness in earnings. Now, in going through this paper, been workshopping it a little bit and receiving some comments, and I'll present it in the way that it's written, but we're going to be changing it over time. So I'll skip through the first part about what we do, hopefully fairly quickly. So first of all, what I'll talk about is essentially how we replicate and extend Sudipta's 97 paper. And essentially what our aim here is to do is to show that asymmetric timeliness is indeed a robust finding across time periods, across cohorts, across a number of various factors. But then where it goes to is essentially where we try to get in the punchline of the paper. So we deviate a little bit to consider the impact of loss firms over time, but the main punchline is to use the approach that I developed with Marlene and Marlene Plumley and Brian Roundtree in looking at how we can disaggregate earnings into the market, industry, and idiosyncratic components, and really see what does this tell us about asymmetric timeliness in earnings. And what our expectation is that we would have this expectation that it's the idiosyncratic component of earnings which should be driving any asymmetric timeliness. And we'll go into that fairly shortly. So over time, it would appear that the desirability of asymmetric timeliness has been downgraded. And so if you take the arguments around and the standard setters, both FASB and the International Accounting Standards Board, which is probably slightly more relevant in Australia here, there appears to be a movement away from the desirability of conservatism and an increasing importance attached in conceptual frameworks to this notion of the value relevance criteria with a corresponding emphasis on neutrality. And so what we want to do here is essentially examine, well, is this evidenced in the data? Do we actually see that there has been a corresponding move away from conservatism, or is it persisting over time? Now, a number of prior studies also examined temporal changes in various earnings quality measures, such as Anoop Srivastava's 2014 JE paper and value relevance. But there's been relatively little analysis in a concerted attempt to examine the extent to which earnings continue to reflect conditional conservatism. Now, we acknowledge that there are many papers which still examine conservatism or asymmetric timeliness, but not necessarily in a robust examination of a number of different areas. So we're trying to approach it here very head on, whereas a lot of literature which our results confirm do it in a more indirect sort of manner. Now, even though, as I said, that the prevalence of a decision usefulness perspective appears to be the overriding objective, at least more recently, we still expect that asymmetric timeliness is more likely to be evident in later years and in more current periods. And one reason for this is that there has been a number of significant changes in accounting standards. And two very good examples of this would be the pooling method for acquisitions and the requirement for impairment testing for recognized goodwill. Now, even though we've got this rhetoric from the standard setters, which appears to be moving away from the notion of asymmetric timeliness, a perfect case study for where you should expect conservatism to exist is indeed an impairment testing of recognized goodwill. It's a case whereby there's the inability to write up goodwill, but you're able to, or you're required to, under certain conditions, write down goodwill. So indeed, even though the standard setters are saying we've got this focus on neutrality, some of the standards which are being written are indeed inconsistent with that and consistent with the notion of conservatism. We also have evidence that the correlation between earnings and contemporaneous returns has generally declined. So what we're talking about here is if you go back to Sedipta's original model, the main coefficient on returns in the model is going to be providing this correlation between contemporaneous returns and earnings. Now, the original model, Sedipta's original results show that this is positive, and especially when you include in the interaction terms with negative return firms. But over time, we've seen that this has either become insignificant or has become negative. And again, what this would lead us to expect here is that indeed asymmetric timeliness is likely going to be actually more evident. And we've also got an increasing instance of loss firms that are able to generate positive stock returns. And one of the arguments surrounding this is going to be from a Harvard Business Review paper, apologies for any pronunciations, Govindarajan et al., which essentially argues that traditional accounting is unable to adequately capture the underlying business economics. And so when you've got these types of firms who are recording losses, but are able to generate positive returns, what we should be seeing here is actually conservatism is going to be increasing. Now, it's conservatism in the way that the accounting earnings are reported, as opposed to necessarily any other attributes of the information processing. So that then leads us to the question of, well, why does asymmetric timeliness actually exist? And there's been a number of reasons for this proposed. And what we're trying to do here is we're trying to dig down more into this and try to examine the why question here. So if we think that asymmetric timeliness is primarily a response to information asymmetry or verification type issues, then it should primarily be evident in the component of earnings that is going to be hardest for external users to be able to verify. And we rely on the model from Bourne, Kothari, and Nikolaev to back this up here. We then take the framework that we've developed to break earnings into its three components. And what our expectation then becomes is that these issues reflecting information asymmetry and verification concerns should predominantly apply to the idiosyncratic component of earnings. And so what we do in going off and doing our tests here is we're essentially trying to determine, is this the case? And if conservatism is showing up in the idiosyncratic component, then it does provide this reflection that conservatism really is a response to these information asymmetry and verification type issues. Now, just as a bit of a preview very shortly, what we first of all do is we show that we're able to replicate Bezout and show across a longer period of time that asymmetric timeliness continues to be evident. We also show that the main effect, so this contemporaneous correlation between earnings and returns, becomes weaker over time, and that this does reflect an increasing number of loss reporting firms, and especially loss reporting firms who also generate positive returns. We show that asymmetric timeliness remains remarkably consistent across time periods, cohort effects, the interaction of time periods and cohorts across different industries, different sample compositions, and alternate specifications. And then finally getting to the punchline, which in the rewrite of the paper is going to be number one here, we showed that asymmetric timeliness is almost exclusively attributable to the idiosyncratic component of earnings. And so this provides some sort of confidence here that conservatism does exist because of these information asymmetry and verification type issues. So first of all, what we do is we go off and replicate Bezout. So good science, results should be replicable. So one, we're able to replicate Bezout. Two, Sudipta has got a well-described paper here. He already knows that. Yes, May.
And I have two questions. Let's first move to Anya and then Stephen.
Andrew, I haven't kind of really got the research question yet, but I think after you presented the main results, I think my question is your right-hand side variable, the return is a firm level return, but your dependent variable, I'm talking about table 7, is you have a market components, industry component, and idiosyncratic component. And then as a horse race, you find that idiosyncratic component of EPS is more correlated with the firm level returns. And one thing I've thought about is that to make the race more comparable, have you thought about using industry level return on the right-hand side or just market level return? But I kind of hesitate to ask this question because I don't exactly know what is the research question, that what you really want to capture, what type of a news you want to capture. So that may not be a valid question if I actually got the research question on.
No, it's a valid question, and it's something that we have been discussing recently. And the question becomes, well, should it be the way we've been thinking about it is, should we be looking at essentially also disaggregating the returns into a market component, an industry component, and a firm level component? So that's essentially on the to-do list. So it's something that we have thought about, and it's something we are going to do, yes.
All right. Next, let's move to Stephen.
I just had a short point to make. I remember Ed, I remember talking to Peter Easton. I don't know if he's on the call, but a while ago, and he said he's tried to replicate Bosu's reverse regression thing using median regressions, the Tile-Sen regressions that Jim Olson promotes, and he couldn't replicate it when at the median level. So you might just talk to, I don't know if Peter's on here, I don't think he is. You might talk to him about that, okay, to see what's going on there.
Okay, I'll definitely reach out to Peter, thanks.
Next, I saw Sudipta Basu raises a comment. Sudipta, do you have a question?
Yeah, so it seems to me that prior literature shows that conservatism is highest during recessions. And it seems to me that that's not idiosyncratic, but more likely economy or maybe industry. So can you reconcile the sort of findings from prior literature? I'm thinking of Jenkins, Kane, and Valluri in 2009 and Gunn, and Stein in 2018.
Now, we've done something with this, and I'm just trying to think what we've done. So I think what we looked at was essentially, not sure crash periods is the right term, but we looked at the 2007, 2008, 2009 period, the sort of dot-com bubble burst, the Black Friday crash, so was that 87, 88, the oil crisis. Now, my memory doesn't quite, my memory eludes me a little bit here, but I think what we find is something going on there, but it's not sufficiently different from the rest of the, if you just take those periods and then compare it to essentially these non-crash type periods. So, as I said, we've sort of had a look at it. We'll probably need to go back and have another look at it. But I don't think that there's something going on, but nothing which is too different from all the other periods.
Okay. Sudipta, do you have anything going back, or we can move to the next question?
So just to follow up on Stephen's comment earlier, if you take a look at Peter Easton, 1999, Accounting Horizons, he has a very nice figure where he does distribution by percentile of returns, and you can see that at the median, it is almost linear.
Okay.
Documented as far back as 1999.
Okay, fine. Well, that's good. I just that just came back to me, that Peter mentioning this over a beer sometime probably. So you might just talk to Peter and connect with Sudipta too on what he's observed also. But if you're talking about robustness, you want to make sure of that before you proceed.
Yes.
All right. After Sudipta, let's move to David Windisch. David?
Hi. So I think my comment was very closely related to Ayung's initial comment. So in terms of if you pull out from the dependent variable things like the industry and the market, I think you should also do that from the independent variable. There's a Gormley-Matza paper in RFS 2014 that nicely shows that you get a lot of econometric biases into your estimation if you don't do that, because you keep in the industry average on the independent side, for example, but you pull it out on the dependent side. So I think you should think about doing that. And just a conceptual question. So how would that be different from using a kind of fixed effect structure? I know that your structure is a little bit more sophisticated in terms of how you do the split, but still, if you would use fixed effects, even if they don't pull out the market and the industry in that sophisticated way, like you do it, but conceptually it would be very similar, or wouldn't it be?
I think smarter people than me would have a better response to that, or a quicker response at least. I'll have to have a think on that. I don't have an answer right now, but
I can answer that for you, Andrew.
Okay, thank you, Ayung.
So for fixed effect, you are assuming a constant term for industry over time. But I think what I believe Andrew did is actually over time, each industry may have a different kind of like level of risks. At the same time, each firm may have a different sensitivity to that level of risks. So these two components, the product of these two components become his industry EPS or market EPS that cannot be captured by the constant fixed effect.
No, I fully agree on that. That's why I meant it's a more sophisticated way of pulling out that effect, right?
But it allows the industry and the market level risks to vary over time, and also allow individual firms to have a different sensitivity to these two components over time. So it's just more precisely describe how firms actually have those different components.
No, I definitely agree on that. So I was thinking about how it would compare to a fixed, right? If there would still be an additional value of doing that.
Yeah, so the fixed effects might get to the same theoretically, but I think practically, as Ayung said, given that we do allow for cross-sectional and also time series variation, then the fixed effect, assuming that everything's being held constant, is not going to work in the same way. So I think conceptually they are different, whilst theoretically there may be similarities.
So Andrew,
yes.
The list of questions right now is gone, but okay. I have two questions before I let you go easily. So the first question is, I want to get your ex-ante expectation. Before you actually do the tests, when you decompose these earnings components into market, industry, and idiosyncratic sources, I know that you were expecting most of the asymmetricness would kick in at the idiosyncratic firm component. But what about industry? Do you expect some asymmetricness at the industry component? That's the question that I'm struggling before I see your results.
So theoretically, what my expectation would be is that where you've got industry common or earnings which is based on industry common information, then there should be less verification or information asymmetry type issues, because investors are able to really look across the rest of the industry and get an understanding of what's going on there. And so I don't think that there should be as great an information asymmetry within the industry component, and it's going to be broader for the market component. And so I wouldn't really expect there to be the same, if conservatism exists because of these concerns, then I wouldn't expect it to be evident within the industry component.
Yeah, I was initially thinking it probably is mainly related to how these contracts are set, right? It's really related to the needs of contract verification. To what extent, I don't know. Whether in certain industries, the contracts are mainly be based on company numbers, firm numbers. Maybe, I don't know, whether some contracts would be related to the industry. And my second question is related to, I believe in your sample, you focuses on, let's say, US numbers, US companies.
Yes.
What about, let's say, we bringing this whole decomposition to another, let's say, accounting standards, let's say IFRS, would you expect the similar pattern to hold?
So I'd expect the similar patterns to be holding there as well. In Australia, we can't do this disaggregation, so we don't have quarter reporting here, so practically we can't really do that with the same level of accuracy, even though there is a large amount of, well, there is potentially error in this disaggregation approach. If we were to have a different country whereby we could do that disaggregation, my expectation would be that it should still be evident only in the idiosyncratic. It shouldn't exist within the market and industry as well, for the reasons that we have. And I don't think that between FASB and IASB that there really is, whilst there are differences obviously between the two sets of standards, at a fundamental level, I don't think that they're that greatly different that it should lead to a different expectation either.
Okay, I personally think that would be interesting to document. Okay, with that, please just go ahead with your presentation. If I do see questions pop up, I will call the audience's names. All
right, thank you. So first thing that we've got here is essentially the replication. And so Sudipta's paper originally, and for very good reason, as he will explain, not here, obviously, but if you listen to him, he only looks at Amex and NYSE firms. We replicate this result largely and extend it out to all firms as well, with no meaningful difference. We extend the sample out into later periods, and what we see here is we get this main effect becoming negative, but largely other than that, we still get consistent results. So we're able to replicate what Sudipta's done. We then also graph out what this looks like, these annual coefficients look like on an annual basis. The large parts in what we're doing here is essentially showing that the main effect on return has been becoming negative over time, and we've got a significant downward trend. And this asymmetric timeless coefficient has been trending upwards over time as well. So again, in contrast to what the standard setters have been saying, asymmetric timeless actually appears to be getting stronger over time as opposed to disappearing. We then look at.
So, Andrew, can I just interrupt you for a second? So, Peter posted something about the econometrics. He has a long post about something you want to find out about smart people. So maybe let Peter explain to us a bit more. Let's see. Peter, are you there?
Yeah, hi. It wasn't really a question. It was just for information. There was a conversation earlier about whether the OLS results are robust. Jim Olson actually has a paper using the TS regression, and I've posted the abstract there. Basically, Jim concludes, this is Kim and Olson in JBFA a couple of years ago, concludes that the Basu effect is robust. So I guess that sort of answers some of the earlier questions. The advantage of the TS approach is you don't need to scale by price, and therefore, you know, the scale effects are basically mitigated if there are any.
Thank you for that, Peter. Now, it's also worth noting that we acknowledge that there have been many criticisms of this reverse regression model. We're just taking it as given. We acknowledge the limitations, but it's also why we do provide an alternate specification and we get the same sort of results. But it'll be definitely worth us looking into using these other non-OLS approaches just to ensure that what we're getting is robust. So other things we do is we look at cohort effects. So essentially the first decade in which the firm enters the sample. if anything, what we're showing is that the asymmetric timeless coefficient is increasing in magnitude in each cohort. We're getting the same negative sort of coefficient on the return after the 1990s. Time periods, again, we're getting very similar sorts of results there. And then the cohort effects by time period. Now, essentially what we're trying to do here is we're trying to rule out that any change in the asymmetric timeless is either being driven by specific time periods or by specific types of firms. And the fact that we're getting fairly robust results here is really helping us rule out those other sorts of explanations. We then move on and think about the impact of loss firms. So over time, as the number of firms listed has increased, so too has the proportion of firms suffering losses. So in our sample, we find that the correlation between the proportion of loss firms and the log number of observations per year is almost, it's just over 64%. Now, as I mentioned earlier, Sedipta's original sample was only drawn from NYSE and Amex firms. We also know, however, that the proportion of loss-making firms on the NASDAQ is greater. And we show this again, looking at the proportion of firms in our sample by year, by NYSE and Amex, by NASDAQ, and all other firms, which we just label as over-the-counter here. And so what we also find is that proportion of firms within the sample or in the CompuStat universe being listed on NASDAQ versus NYSE and Amex is also increasing at a greater rate. And so the listing status is also of importance when we're trying to consider what's going on here. Now, what's also very important in thinking about these relationships is where or what type of firms do we have? And so figure 2 from Sedipta's, from Bazoo 97 provides us with these 4 types of quadrants. So we've got those firms who are making positive returns and positive earnings, loss-making firms with negative returns, but then on the other side, we've got the profit-making firms with negative returns and loss-making firms with positive returns. Now, if we're thinking about just that main effect on return, an increase in loss firms should not really impact on that return coefficient if they're also reporting negative returns. The flipping of the sign or the flattening of the coefficient here would tend to suggest that it would require an increased instance of loss firms who are also generating positive returns. And so if we think about these different quadrants by quarter, what we're showing is that over time, not just is the proportion of losses increasing, but also the proportion of losses who are generating these positive returns. And on an annual basis, the graph looks quite messy, it jumps around a lot, but generally what we're seeing is that over time, these quadrant 4 firms are making up a much larger proportion of their overall sample. So why is it that firms earn losses but generate positive returns? And there's many, many reasons for this. One particular rationale which has been put out there by this Govindarajan et al. Harvard Business Review paper links it back to the types or take the case of digital companies. And so their argument here is that the building blocks of this, such as R&D, brands, organizational structure, peer supplier networks, and others, are all going to be items which, according to the accounting standards, must be expensed immediately. The economic purpose of these investments, however, is no different to the industrial factories and buildings of typical manufacturing type firms. So we've got these investments which essentially serve no different economic purpose, but according to the accounting rules need to be treated quite separately. So the manufacturing firms are going to be capitalizing these, expensing them via depreciation or any impairments. The digital type companies here are going to be providing these items being expensed up front. Now, necessarily what this is going to mean is that these digital type companies are going to be conservative by definition, just by the accounting rules. So where the accounting does not capture the underlying business economics very well, what it means is that investors are going to be forced to disregard earnings in their investment decisions. And so we're going to have these loss-making firms being assessed in a different sort of manner to your maybe traditional manufacturing firms, and they're going to be generating potentially these positive returns. Now, if we think in a normative type of structure about, well, what does this mean from the accounting standard setting perspective? Does it mean that the accounting rules should be written so the underlying economic purpose here is considered, even though there might be greater verification concerns around these types of building blocks for these digital type companies? Or is it going to be the case that, well, accounting is designed for a certain purpose, but investors are able to take information from other sources, and the accounting is not necessarily the only impact in the pricing decisions? And indeed, the pricing isn't necessarily the only reason why we've got the accounting standards out there in the first place. Now, this is a sort of question that this analysis provides here, and it almost goes to an existential question around, well, what is the role of accounting? Now, I'm not sure that I answer that here, or I've got necessarily any views supported by any data here, but it's something worth thinking about from an accounting design perspective.
So Andrew, I
Yes.
have another question coming from David Windish.
Just maybe a quick clarification question here. So because you say you don't have data on that, but is that not actually what you test later on because you pull out the industry separately from the other factors? So basically, if you would argue that this is on an industry level, right? Because these firms are mostly kind of clustered in certain industries, isn't that exactly what you're separating out later on?
Maybe, but maybe not. It really depends on how industry is defined and how firms are sorted into industry. So if you take the case of, so Amazon, for example, they're making profits now, but in the early days, they probably would have been consistent, this type of firm. You've got something like Snapchat, I think it's probably fits within here. Uber, I think would be another example fitting in here. Now, I'm not sure that, I don't know what the industry is for those three firms are there, but I'm not sure that they're necessarily going to be in the same or classified as being in the same industry. So it might be that some industries are more likely to capture these types of firms, but I don't think it is going to mean that every industry or every firm within an industry is necessarily going to be these types of firms. So if you think about, what is it, IT? I forget what JIGS officially calls it, but that sort of IT is not necessarily also going to capture only digital firms. There's going to be other more traditional type firms within there. So it might be that some industries are more likely to capture these firms, but not necessarily entirely have the entire picture there.
Okay. No, I thought just because you have this way of within the industry, right, pulling out. So I thought that should be captured. But okay, thanks.
Next, I have Ayan again. So Ayan, please.
Just have a follow-up on David's kind of comment. I think there's an easy way to test what you just talked about related to this slide, that there are certain industries are more heavily investing on R&D intellectual properties, and due to the unconditional conservatism potentially leading to this irregularity, that's the earnings return relation actually is insignificant. I think you use the GICS 2-digit industry code, right? use a finer industry code. I think GICS actually does a good job identifying, for example, pharmaceutical R&D lab sectors. I can give you that specific code. They even have a social media sector where the Facebook, Twitters are there. So those are kind of cleaner, smaller sector where you definitely know all the firms within that sector heavily investing in R&D. I think if it's just 2 digits, like you say, IT has a lot of things, can be traditional telecommunication firms, telephone companies versus kind of like Facebook, and you got very noisy results, but going to the subsectors will help you build that case that you just talked about. Yeah.
All right, thank you.
Okay, so I think Jonathan Glover also probably has some suggestions on how to test this. So Jonathan.
Not nearly so ambitious. I just wondered if relating it to growth stage would be natural, that, not only the growth, sort of what the growth stages of the industry, but variation in growth within the industry.
Can definitely take a look at that. Thanks, Jonathan. Now, what we do go off and have a look at is when we do split up the firms into their specific quadrants. And here I've only got it for the quadrant 4 versus quadrant 3. So only looking at loss firms here. So quadrant 3 is going to have negative returns, quadrant 4 positive returns. What we do show is that these quadrant 4 firms are more likely to have higher levels of intangibles at the median, not the mean, intangibles, but greater amounts of R&D expenditures as well. So I think it goes slightly towards saying that, well, these firms generating positive returns do have this greater levels of intangibles and R&D expenses, but definitely not as clean as say what Ayung is suggesting there. What we also show is that where these firms are listed is also making a difference. And so just by looking at, say, quadrant 1 to 3 versus quadrant 4, it's very clear to see just visually here, even though we don't have any specific tests on this, that they're more likely to be NASDAQ type firms, which again is more consistent with they're probably more likely to be these digital type companies.
All right, Andrew. Now I have Vivek Raval who has a question.
Hey, Andrew, just a question on the prior slide. I just want to make sure I understand, sorry, 2 slides back, make sure I understand sort of where you're going with this analysis, the quadrant analysis, right? So it seems like when we look at the lower right quadrant, we're talking about firms that have positive returns but negative earnings, right? These firms seem to be, you're proposing that these firms are in that quadrant because they have a heavy influence of unconditional conservatism. So they're forced to expense. And that's not reflecting the appropriate assets on the balance sheet. And are you trying to then connect that to the conditional conservatism that you're observing when you do the Bossut regression?
So that was the aim. We haven't managed to make that link yet because of not being able to, or not essentially being able to directly say, well, these are these firms. From the comments received, whereby we're essentially being told this is where to look. That's what our aim is to be able to go off and show now. And then, so what is your do you have an ex-ante hypothesis as to what that relationship would be just in the abstract between that unconditional conservatism? At the moment, no. It was more in terms of trying to provide, well, here's one explanation for it. I think at the moment we're probably making too much of it. What we're trying to get to right at the start is the punchline, which is the earnings disaggregation, which in the way the paper's currently written is the back end where we've got to get through a whole lot of stuff. So in the coming weeks when we're rewriting the paper, the next part is going to be the punchline right up at the start. And essentially what we're looking at, these are more trying to rule out other sorts of explanations along the way.
Makes sense. Thank you.
Thanks. So as I said, the punchline in the paper really is this earnings disaggregation. And so if we think about asymmetric timeless as reflecting differing verification standards for good versus bad economic news, but that verification issues increase with the level of uncertainty, then here we think that this disaggregation approach is able to help us address the why. And so is this really why asymmetric timeless does exist? And we know that not all components of earnings are equally certain or uncertain. So if we think about the difference between cash flows and earnings, cash flows are going to contain the easy to verify information, which is going to be incorporated in a timely fashion. Accruals are going to make up the difficult to verify information that drives the level of asymmetric gains and loss recognition. So consistent with Sloan 96. Now, if we think or apply that to this earnings disaggregation, whereby we're able to say what portion of earnings is attributable to market, industry, and idiosyncratic components, the extent to which revenues and expenses are attributable to market-wide or industry effects, then the expectation here is that external users have access to macroeconomic factors as well as industry reports, which should reduce this uncertainty around expectations at the firm level. The extent to which revenues and expenses, however, are idiosyncratic, then external users are going to be facing difficulties in forming robust expectations. And so again, Jackson et al. 2018, another working paper I've got, Han et al. Also show that the idiosyncratic earnings is less persistent, which is consistent with this notion here. We also get to these notions around conditional versus unconditional conservatism. So the extent to which unconditional conservatism reflects predetermined effects of accounting standards, then this should be closely associated with market-wide and industry-specific effects. So thinking about the cleaner ways of identifying stock or these different sectors should hopefully help us identify areas where we should be able to observe greater unconditional conservatism. Conditional conservatism, however, is more likely to be influenced by firm idiosyncratic earnings, which is going to force the asymmetric recognition of losses relative to gains. So over time within the US, there's been a continual growth in the economy, give and take a few years. Write-downs are going to be less likely to be based on market or industry commonalities, and we'd posit that it's more likely going to be based on firm idiosyncratic factors. As an example, we'd say have a standard which is going to be based more on idiosyncratic information than market and industry. And we also expect that this decline in the association between earnings and positive economic news is going to be primarily concentrated in the idiosyncratic component of earnings.
Okay.
And so
Andrew,
yes, May, sorry.
Sorry for interrupting again. I think Sudipta has another question.
So yeah, there's a paper by Alciatore, Easton, and Spear in 2000 in JE looking at oil and gas accounting, where they have a very strict law of cost of market rule that's based on oil prices. And so they find that impairments in oil and gas industry are very highly correlated with oil prices. And so that seems to be a market-wide phenomenon. The price is a market-wide or at least industry-specific price. And I can't see how that would square with the idea of this being idiosyncratic rather than at least industry specific.
In that case, no. That would be a good example of one where it should be industry-wide, But then would it not suggest that it's going to be more of an unconditional type of conservatism there, which is related just back to one specific industry as opposed to the entire market?
It is conditional in the sense that it depends on whether your oil price is going up or down. It's only when prices go down that you impair, but that's sort of more generally, if you think about inventory, you're doing low of cost to market on inventory. That's based on prices in the industry. So I think it does generalize much further. I mean, they show it because there the rule is especially tight and they can they have the oil price measure. But they also show that if you look at the stock prices of those firms, you get the same result. So the returns are reflecting the oil price, which it should in an efficient market.
Yeah.
But I think that the driving force there is oil prices. And I think that in general, firms' impairments are going to be affected by prices for their products. So I can't see how you could get away from at least an industry-related effect. I mean, it just seems weird that it's all idiosyncratic.
Mm-hmm.
So Andrew, related to Sudipta's comments and my earlier comments, I also think about quite a few scenarios like the dot-com bubbles or even like the financial crisis to the banking industry. I can think about several scenarios where I view, again, this pattern might show itself at the industry level. So I'm still not quite clear why, at the industry level, you should not expect it ex ante. That's just not very clear in my mind.
Okay, we'll have to go back and have a more careful think about that as well. So one thing which we did do is we repeated this analysis here, which is where we've got the breakdown. Now here we've got the total returns and as I mentioned right at the start in response to Ayung, that we need to think carefully, and we will go off and have a look at disaggregating these as well. But within the banking sector, it was the only one whereby there was some evidence of asymmetric timeless at the industry level. Mm-hmm. And if you have a look at the results here, we get some sort of coefficient or positive coefficient. The magnitude is extremely low here though. But yeah, the point's well taken that we need to think more carefully about providing a more convincing story up front as to why we've got these expectations.
Yeah, and particularly you would think about maybe some industries are more prone to this effect and others, maybe traditional manufacturers, would be less. I don't know. So I think there are some differences. And also, I think Ayan has a question. I don't know whether it's related or unrelated.
Yeah, I think it's related. It took me probably 50 minutes to think about this. I think our discussion here is that the right-hand side variable is a firm level return. And then somehow it made me think about like how likely an individual firm's news is actually going to have an impact on the industry versus market. It's very unlikely. I think in a macroeconomic literature, usually individual firm unlikely has a kind of like systematic effect. And I don't know whether that actually is what your results capturing, but when you talk about banking, it's likely a very large bank actually has such a systematic effect. So it seems kind of consistent with that intra-firm network literature in econ when they talk about certain specific conditions when individual firms actually able to penetrate or has a bellwether effect on the rest of the economy. And that potentially is what you capture here. But I'm not 100% sure, but it sounds consistent with their theory. I think that would be one direction to give us some kind of economic intuition about how you find. I feel like the paper so far has been very descriptive, but we don't know going forward, how do we cite your paper when we are in this space? That what is the punchline takeaway. What's the economic story?
Yeah, point well taken there. Thank you.
And I think related again to this point, Stephen Taylor has something to say. Stephen.
No, I'm just reinforcing a couple of earlier comments and saying, yeah, definitely we would take away on this paper the point that to the extent that the paper is really needs to be focused around the evidence of asymmetric timeliness being very much clustered in the idiosyncratic component of earnings. I think Sudipta made a really good point about oil and gas, for example, as an industry where impairment is likely to be around a common factor, whereas there are industries where impairments, for example, are much more likely to be idiosyncratic. And I guess the challenge for us as the authors is to think about what is an ex ante, powerful way of building an argument about how that would work. I mean, I'm sure that we could dig through the industry data and find differences by industry. But that's not really the point. The question is thinking about, to what extent do accounting standards essentially result in applying economy or industry-wide information versus idiosyncratic information. And that's ultimately how we got interested in this thing in the first place. But I think as a result, we sort of went back and sort of looked at a lot of historical evidence generally on conservatism. But this is very much where I think we see the paper going in terms of what its punchline ultimately would be.
Okay, so we actually have 4 minutes left for Andrew. So maybe we'll stop taking questions. And Andrew, please wrap it up within 4 minutes.
All right, thank you. So essentially what we're showing here is that across the market, industry and idiosyncratic components, taking into account the previous comments about is this the right specification or not in terms of the returns. But what we're showing is that we're getting some sort of result on the industry component, but not in that 91 to 2019 period. It's all in that pre-1990 period, but it's almost exclusively within this idiosyncratic component. We also look at trying to have a sense of, well, is this driven by the proportion of news which is idiosyncratic or not? And so we split this into those firms which have more versus less idiosyncratic news. And it's almost monotonic that this asymmetric timeliness is getting stronger the more idiosyncratic earnings that there are. And finally, what we show here is that also that this is going to be the strongest, however, when we've got idiosyncratic earnings being negative. Now, at the moment, I've just showing this, it's very descriptive. We haven't really thought anyway about why this is the case, but it's something that we need to consider. So overall, what we do is we document that asymmetric timeliness is a robust phenomenon that has persisted over time. It appears to be consistent with an increasing frequency of losses. Consistent, we've got no causation that we can say here, and that it's almost exclusively within the idiosyncratic component. So what in terms of all of this then? What have we actually done? Well, first of all, what we're arguing here is that, well, our results appear to be consistent, that conservatism really is a response to uncertainty. So the uncertainty is significantly greater within this idiosyncratic component, and so it appears to be a reflection of this response to uncertainty, not just an across-the-board reflection of accounting standards. Also, to the extent that asymmetric timeliness appears to be only within the idiosyncratic component, suggests that firm-specific factors have an important role to play in predicting and explaining variation in conservatism. And this goes a lot further than, say, the Kahn and Watts C-score, whereby it's only looking at 3 components. And one thing that we could potentially move into is that there is some evidence on conservatism at the aggregated level. Our disaggregation analysis suggests something slightly different there, but the way in which these aggregated level studies have approached this versus our approach is quite different. So we need to be much more careful in terms of making any sort of conclusion there. So I think I'm out of time now. What I would like to finish up by saying is advertising next week when Stephen Terry from Boston University will be presenting at, I think, what I understand is a much friendlier, at least Eastern Standard Time, next Wednesday back at 11 a.m. So thank you very much for your comments. And again, thank you to Ayung and Stephen for organizing this fantastic event. And all your comments are greatly appreciated.
May I suggest let's all unmute ourselves and give Andrew a round of applause.
Thank you, Andrew.
Thank you, Andrew. And thank you, Aya and Stephen.
Yeah, thank you, May.
See you next time.
Thank you, May.